Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. The Taxman Cometh. So, after a year of government stimulus spending, which very few people objected to, everyone loves free money, of course, the conversation has turned to how we're going to pay for all this spending. Well, higher taxes, of course. The Biden administration rolled out plans this week for several tax measures it would like to see enacted alongside new infrastructure plans, among other initiatives. The tax plans include higher levies on the highest income earners, higher capital gains taxes, and higher corporate tax rates. So while we must admire the attempt to pay for all of this profligate government spending, which has been taking place and will continue to take place, higher taxes risk exacerbating the building inflationary pressures in the economy. When we raise taxes, we squeeze the supply side of the equation, resulting in obviously higher prices of goods and services, something we've been seeing over the course of the last several months. And this affects everyone regardless of tax bracket. So while many analysts are warning that higher taxes could undermine the stock market, it's those inflationary pressures which we're really more worried about. And that could actually extend to inflation in stock prices as well. For this week's featured insight, don't forget to rebalance. Most investors are thrilled that their portfolios have rebounded from last year's pandemic-induced plunge, but they may not be realizing that their overall portfolios may be far riskier today than they were last year. With the stock market up nearly 50% over the last 12 months, and bond markets essentially flat to maybe even slightly lower than they were, a portfolio that started out last year at 60% stocks, 40% bonds, will have ballooned to nearly 70% stocks relative to 30% bonds, bearing significantly more risk than it started out doing. We recommend that investors look to balance portfolios, rebalance portfolios that is, by harvesting some of the gains in their equity allocations and reallocating those funds to safer investments like bonds and other areas that bear less risk. Looking ahead, on the lookout for peak data. Markets trade on rates of change, and the odds are growth is going to begin to slow as we move into the second half of this year. 20% earnings growth for the third quarter sounds great, but it's not as good as the 50% earnings growth we're expecting in the current quarter, that is this year's second quarter. Less good is in fact bad for the stock market. So while it's probably still too early to be sounding the alarm bells, growth still is accelerating in fact. We may see fit to start recommending scaling back on some of the things that have worked so well for the last 6 months. That is, the cyclical areas in sectors like energy, industrials, and materials, and adding to positions in more defensive areas like utilities and consumer staples. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.